Do you want to avoid common investment mistakes? Navigating the world of finance can feel like venturing into a labyrinth. It's a universe filled with opportunities, yet fraught with pitfalls. An essential part of this journey is investment. It's how you grow your wealth, secure your future, and maybe even make your dreams come true. But, like any journey, it's not without its share of challenges and missteps. People often stumble, making common mistakes that can turn promising investments into financial nightmares. These errors range from not doing enough research to ignoring market conditions, from lack of diversification to investing more than one can afford to lose, and even chasing past performance. But worry not. This video is your compass, guiding you away from these common investment pitfalls. We will be discussing the top 5 things to steer clear of when making an investment. So, let's dive into the top 5 things you should avoid when investing. The first common mistake is not doing enough research. Imagine walking into a dark room without a flashlight. You wouldn't know what's in there, would you? That's what investing without adequate research is like. It's a game of chance where the odds are stacked against you. Investing isn't about throwing your money into the wind and hoping for the best. It's about understanding where you're putting your money. This means knowing the ins and outs of the company you're investing in, the industry it operates within, and the overall economic climate. Without this knowledge, you're essentially flying blind, and that's a risk you don't want to take. So, how do you go about doing effective research? Start by reading up on the company's financials, industry trends, and market forecasts. Seek out expert opinions and never shy away from asking questions. Remember, knowledge is power when it comes to investing. The second mistake is ignoring the market conditions. It's like setting sail in a storm without checking the weather forecast. Just as a seasoned sailor knows the importance of understanding the sea's temperament, a savvy investor must grasp the mood of the market. The financial market is a dynamic entity, constantly shifting and changing. It's influenced by a plethora of factors, from global politics to technological advancements, from economic indicators to social trends. Ignoring these realities can lead to poor investment decisions. Suppose you're investing in a company without considering the market conditions. If the market is on a downturn, even the most promising company could see its shares plummet. Conversely, in a bull market, even mediocre companies can see their share prices soar. So keep your finger on the pulse of the market. Stay informed, stay updated, navigate with knowledge, not just intuition. Being aware of the market conditions can save you from potential financial pitfalls. Thirdly, a lack of diversification can be a major downfall. Imagine having all your eggs in one basket, and that basket falls. You lose everything, right? It's the same with investments. If you invest in just one type of asset or one particular company, and it doesn't perform well, your entire portfolio takes a hit. Diversification is like spreading your eggs across different baskets. It's about investing in a variety of assets, such as stocks, bonds, real estate, and more, from different sectors and geographical locations. This strategy helps to manage risk. If one investment doesn't perform well, others might, thereby reducing the potential damage. Remember, the objective of diversification isn't necessarily to boost performance. It won't guarantee gains or shield against loss. But it can help you reach long-range financial goals while minimizing risk of loss. It's a fundamental concept that helps in achieving a balanced and well-rounded portfolio. Diversification is key to managing risk and achieving long-term investment goals. The fourth common mistake is investing more than you can afford to lose. This principle might seem like a no-brainer, but you'd be surprised at how often it's overlooked. It's easy to get carried away by the allure of potential profits. But remember, there's always a risk with investments. When you invest money, you should be prepared for the possibility of losing it. This doesn't mean you should expect to lose, but rather, you should be in a position where a loss won't jeopardize your financial stability. Think of it this way. If you're investing money that you need for your mortgage, bills, or other essential expenses, you're essentially gambling with your financial future. The potential consequences can range from debt and financial stress to bankruptcy in the worst-case scenario. So, before you jump into an investment, take a step back and honestly assess your financial situation. Can you afford to lose what you're planning to invest? If the answer is no, then it's probably not a wise decision. Never put yourself in a position where a bad investment can ruin your financial stability. Finally, the fifth mistake is chasing past performance. It's a common trap many fall into. You see a stock or fund that's been doing well, and you think, hey, if it's been doing well, it'll continue to do so. Unfortunately, this is a flawed strategy. It's akin to driving while only looking in the rearview mirror. You're basing your decisions on what's already happened, not what's ahead. Remember, the financial markets are influenced by a myriad of factors, including economic conditions, political events, and company performance. These factors are constantly changing, and yesterday's winners can easily become tomorrow's losers. Moreover, a history of high returns often indicates higher risk. By chasing past performance, you might be exposing yourself to more risk than you realize. So don't get swayed by the allure of past successes. Look forward, not backward. Make informed decisions based on current and projected trends, not historical data. Past performance is not an indicator of future results. To recap, here are the top 5 things to avoid when investing. Firstly, never dive into an investment without doing enough research. Knowledge is power, and in the world of investing, it can be the difference between profit and loss. Secondly, always keep an eye on the market conditions. They are the wind that steers the ship of investment. Thirdly, don't put all your eggs in one basket. Diversification is a safety net in the volatile world of investing. Fourthly, remember not to invest more than you can afford to lose. After all, investments carry risk, and it's important to protect your financial health. Lastly, chasing past performance is like driving while looking in the rearview mirror. It's crucial to focus on the road ahead, not where you've been. Avoiding these common mistakes can help you become a more successful investor. Remember, informed decisions are the key to successful investing.